Good morning. It's November 8th. It's election day. I'm here to talk about stocks, here to talk about our different models, here to talk about Nasdaq versus the S&P 500, and just talk in general about how our model works and what we're seeing out in the market, the U.S. equities market. We'll also spend a few moments on debt as well, but really we're focused on equities. And so I'm going to start by sharing the model portfolio, the answers. And so these are the stocks, these are the number of shares. This is using a roughly $900 per position, roughly a $50,000 investment, gets you about $1,000 per stock. The hedge would be about $20,000, and the rest is cash used to make the trades. And so it does okay. It's actually not a bad. It's directionless because it's fully hedged. It's a managed account. We run it over at Charles Schwab, right, where you open up an account, you put your money in. We can't withdraw your funds. We can only trade as long as you say it's okay. And we charge a fee. It's pretty simple. And we do a ton of work in order to be able to have this portfolio. And we have some options. So if you decide you like a different thing, you can have a different thing. So start off with what are our main holdings. And so Apple, AB, ACI, American Financial Group, AMD, Amazon, APAM, Asset Management Partners, ARI, Broadcom, Blackstone, Quart Energy, Earwax, European Wax Center, and others. You see Intuit, Microsoft, NVIDIA, Potash Company, Qualcomm, Rocket Mortgage Companies, State Street. And we had a couple changes today, right? We ran the model. It had us sell Wingstop. Wingstop has run quite a bit. Beautiful stock, right? Went up a lot. And the model said it's gone enough. It's moved enough. And then it had us buy APAM today. APAM's a high dividend stock. Probably showed up in our model because of the dividends. And so today was a very modest change in the model because if you look at proceeds and outlays, roughly equal at about $930 each. No change to the hedge, no change to the downward hedge either. And so let's talk about it. So if you have this portfolio and you see these betas are pretty small. I mean, there's a 2.04 in there for AMD, but there's also 0.86, 0.71, 0.55. So the model is asking that we bring in some lower beta stocks. And a 1.29 is the average beta in our model right now. So if you look at the S&P 500 weighted hedge, right, 58 shares of SPY, which is an ETF, is worth 22,000, which is roughly speaking 1.29 times the $17,000 invested in the 19 stocks. And then you look, we have roughly the same amount in 3 hedges. So this is the other way we can hedge a portfolio. You can use the S&P 500 weighted. By the way, a more consistent, slightly less profitable over time, but more consistent, smaller drawdowns. Or you can hedge using the worst 3 stocks found in our model. These would be companies that lose money and have extraordinarily high variance, closing price variance versus the expected return based on the beta weight of those stocks. And so Bohr, Drilling, Snap, Snapchat, Grab. Bohr, Snap, and Grab. Each one between $5,500 and $6,000 short. So if you look, yesterday was a pretty bad day, right? Because the longs went down $800. The shorts went up $800. So in a $50,000 portfolio, we lost $1,600 in a day with this type of model. In fact, it's funny, you lost $800 and the hedges, the S&P 500 hedge went up $200. So there's a $1,000 drawdown. So it's pretty frustrating when that happens, right? You don't really know what's happening or why it's happening. You just look. Now, we are tracking this versus either closing the night before, or sometimes we do it based on pre-market. And so this is the actual move during the day. And oh, wait a minute. Yeah, that's it actually may not be because of that. It may be because of a small accounting. And so all right, we'll have to fix that. We'll have to go back and double check our pricing, because it looks like we didn't update all of our data based on yesterday's close in order to give you that. So I have to go back and update the spreadsheet, and I may actually just do it here while we're talking. So let's go into it was actually November 7. So November 7, each stock that has shares held should have a opening closing price. Yeah, that's better. That is better. That's funny. This is what happens when you start using, half. It's today's spreadsheet, so we don't have it in today yet. But let's take a look at what we do have. Yeah, these were. These were updated. It's not quite so bad. Daily change. These changes were tiny. The daily change yesterday was $68 to the plus side. So you made $68. On the hedge actually lost $128. So you lost $60. But it was the shorts that dropped $800. And so what happens is you made $68. If you hedge against the S&P 500, you ended up minus $60 and 50 grand. But the shorts went high, went quite higher, $800. It's like they squeezed higher a little bit. Now, if you look today, which is what we do during the day, we'll take a look at those hedges. And you see snap, bore, and grab. Or bore, snap, and grab. And you'll see down 2%, up 0.3%, down 2.7%. So roughly speaking, down about 1.6% times $17,000. It's about $250 you made. On the longs, let's see if the longs went up. My guess is they did. This is a pretty up day, which is interesting because of the election. So we'll just do a quick sort. We're almost all up. 2, 3, 4, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19. So the median would be between 9 and 10. 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10. So 1.58. So you made roughly 1.5 on one side. You made roughly 1.5 on the other. So you made 3% today, which is great, which is a lot of money actually. So we'll take it. 3% in a day, right? And the reason is that the up stocks, the whole market is pretty much melting higher. And you can see, this is where it gets interesting for me. I'm going to make this bigger for you. Because volume. Take a look at the daily volumes. Nothing is trading above its average monthly 3-month, average 3-month volume. Every single stock is below its average 3-month volume. Now you look and it's only like noon, Central, 1 o'clock, but still you would expect to see some stocks trading with some volume. Big stocks, right? Like Nvidia, AMD, Apple, Microsoft. Volumes are all down. State Street. Sorry, I can't take that. Call from New York. And so it's just interesting, right? So things are down. Just is what it is. So the whole market's up on low volume. So when markets rise on low volume, that makes me very nervous. In fact, if I were to look at one particular stock, which I care about very much, then it's trading 89,000 shares, but a 3-month average of about 400,000 shares. So it's about 25%. So volumes. I'm just not seeing the volume today. So question is, do you believe this market? Do you believe it? Do you believe when there's low conviction through low volume? So this is where we're at. Making money today, losing money yesterday. Losing a little yesterday, not much, but a little bit. But I don't like to lose, right? This model should make money every day. Every day. That's the plan. That's why we offer it. That's why we run the job. That's why we do the analysis, right? To make money every single day. And so let's take a look. Let's look at some facts. People like facts. I'm always amazed, right? You tell people, oh, I got an opinion, right? Stocks are going to go up, stocks are going to go down, stocks are going to go sideways. Nobody really cares about your opinion. Sure, some facts, though. The whole thing changes. The whole game changes. And so what facts, Jeffrey, would you like to show? Let's take a look. This is the model output based on QQQ. QQQ. And this is the model output based on the spider. So the spider has a variance of 2.1 and the QQQ has a variance of 3.8. So the first thing you notice is that the QQQ's variance remains elevated. Now that's variance based on adjusted close for 253 trading days. It's much higher. Why is QQQ much higher? That's a good question. Okay. Second thing we look at is there's really been no change. We're at a 9% market floor. Risk-free return is 4.25, and that's based on interest rates. Interest rates being what they are. Let's take a look. Can't find them right now. That's okay. I can pull them up here. Let's take a look at 1-month Treasury. The most risk-free, and most people can do just a little better if you tried. Although then it's not really risk-free, but let's see, it's 3.5. 3.5, and if you go to 1-year money, you're 4.8. So at least 4.25 for a risk-free rate. I'm just assuming that you can do a little better. You can actually go buy some bonds and stuff. Do all right. Get a little bit of risk in there, maybe. So if you look at the model, so there's 1,530 stocks validated, 1,532 stocks validated. It's interesting that when we ran it at slightly different times with slightly different code base, you get two different stock numbers. It's interesting. You can see that the all stock variance is 2.5. So 2.1 for S&P, 3.8 for QQQ, 2.5 for all the stocks. The expected return when you run it off of QQQ is 7.7. The expected return when you run it off of SPY is 8.13 or 9.13. So 7.7, 9.1. So just running off of QQQ, if your worldview is QQQ, the market is more risky. There's lower betas. Lower betas, lower market return, lower return to risk assets. You just don't have as much correlation. Now when you look at the market compared to Spider, there's higher correlations. And there's more expected return. So right there, just as one change. You look at what you get if you just bought the S&P 500 index. You get 3 ticks of, actually if I look at that right, it's 30 ticks. And if you look at the S&P 500 off of the QQQ, so if the QQQ was the center universe, you get 40 ticks if you just bought the S&P 500. So you go through the whole process of running the model. You do all this work. You spend all this time. And you get, from 30, you get 51 ticks. It's not a lot of alpha. 22 stocks. For the QQQ, you get 40 ticks. You do all this work. 38 stocks, you get 54 ticks. It's not a lot. So the first thing I thought last night was maybe we stop. Maybe we just take our money and we just pause until the market changes. This is not a good reading. This is a bad reading. This is a high risk-free rate of return, 9% return to stocks, a moderate return to stocks. But with the amount of risk showing up in those two portfolios, you're not getting a lot of alpha. And I run these models pretty hard, and you're not getting a lot of alpha. And so, just a thought for you, right? That's why you're making $60, $100, $200 off of 50 grand in a day. It's not like we're all gonna, go on a cruise with the earnings. It's a tough market right now. And so, I don't know. I mean, there's always more stuff to look at, right? Let's look at negative beta, Jeffrey. We get people that like beta. That's interesting. Our code, the way we run the code is very, it's working. It's working well. So if we look at where you're going to get some attractive beta, I can get you negative beta. You can go the QQQ short. By the way, my guess is if I do the same thing down here, you'll get exactly the same answer, just a tiny bit different on the numbers. The same data. So if you're looking for negative beta stocks, there we go. First thing you'll see is come on. I know I should be a lot more polished. I should be a lot more prepared. I should give you guys like a show, like a Jim Cramer show, but I ain't Jim Cramer. I'm not Jim Cramer. I'm Jeffrey Cohen. I run a small fund. I'm easy, right? So if we look at the QQQ, so the SQQQ, which is supposed to be 3 times the short on the QQQ, is running almost exactly -3 beta. So yay. That's helpful. I look at the QQQ against the S&P 500, and it's a 3.8 beta. So it's 3.8 times the movement because the QQQ already has more movement. That makes sense. If you're going to play the VIX game, you're going to see smaller negative betas, less power. When you trade VIX against QQQ, you don't do as well as when you trade VIX against the S&P 500. It's almost like the VIX and the S&P 500 are like tailor-made to work together. The VIX and the QQQ, but you lose some of it, right? Second thing is the dollar. Everyone talks about how the dollar is negative for stocks. When the dollar goes up, stocks go down. Well, when the dollar goes up, tech only goes down 11%. Now, why is that? Maybe because tech doesn't make any money. Cherokee Nation. Love that, by the way. I love our Native American people. I'm also a big fan of Pacific Islanders, like Dwayne Johnson. Right? Good people. when you look at the US dollar, you see it takes down almost 17%, the S&P 500. So when the dollar goes up 1%, the S&P 500 tends to go down by 17 basis points. If the dollar strengthens by 1%, you would expect a 0.17% fall in the S&P 500, all things being equal. That's tricky. But it's interesting that your QQQ doesn't really move with the dollar. It doesn't really move as much with VIX, or it doesn't drive VIX as much. Okay. Nothing else should really be different. I just think that's interesting, right? I mean, you look at this now and you think, okay, if I'm going to play around with the VIX, I'm going to do VIX against S&P 500, not VIX against QQQ. If I think the dollar is set to rise because of interest rates, I want to hold QQQ, not the S&P. The problem is when interest rates go up, I bet you there's a TLT or something. TLT. Give me a piece of paper. TLT. I bet you if I were to put TLT in the model, just to run it, it would be a negative on TLT in the S&P 500, call it 0.2. I bet you it's like 0.4 on the QQQ. The QQQ should be much more sensitive to long-term interest rates because you wait a long time to get profit on growth stocks. S&P 500, in theory, are already making a profit, right? The cash flows aren't as backward weighted. I'm going to add TLT. That's it. You guys are very smart out there. Thank you for watching the video and giving me these great ideas. So where are we at? What else do we care about here? I always care about dividends. Albertson paid out a huge dividend. So you know what? The problem with the model is now with these dividends, I don't think I'm doing it right. I think I'm going to have to take down the dividend fix. And you know my old client's going to be very mad. He's going to say that was stupid, Jeffrey. But just take a look. These are stocks that show up in our model. ACI paid a 33% dividend last year against the current stock price. Against the average stock price for last year. Chord Energy, 16. European Wax Center, 15. AFG, 14. ARI, 12. Potlatch Deltic, 12. Alliance Bernstein, 11. I think what's happening now is that the model, BRY, Berry Corp, rocket companies, I think the model is picking these high dividend stocks because there's more safety, right? That the dividend pays you out money, assuming it moves forward. This is very interesting. It's very interesting. So, that's all right. That's another interesting thing. I might take the dividend correction, let's say from 100% down to 75%, 50%. See if we get more edge. Let's see if we get more edge, because high dividend paying stocks are going to act more like bonds, and they're going to drop in this market. So maybe there's something there. That's very, thank you, by the way. So now look at the 1-year treasury. Is it really up today? Nah, not really. Let's look. 5 days. Yeah, it's up. It's kind of flat. It's flat uppish to flat. Let's look at the 10-year. Downish a lot, actually. Down 7 basis points, 7.2 basis points. But still up pretty good. Not quite back to 4.1. Now let's look at the 30-year. So these rates, that's down a lot, actually. Rates matter. Rates matter, especially if they go up to 4.5%, 5% for 30-year money. It's a pretty good rate. And so interest rates are up, but today they're down. Today they're correcting. I guess because it's election day, maybe if the Republicans win, they're going to somehow magically make long-term interest rates go down. I have no idea how that works, by the way. So what else are we going to look at? Let's go back to where we were. So these are dividend stocks. A lot of these are dividend stocks, right? And so interest rates go down, dividend stocks go up. That's true. So let's take a look. I got 1 down, 2 down, all the rest are up. Got some nice ups too, 6%, 5%. And model's going to make some good money today. Model portfolio. We look at the hedges. Remember, we're only hedging these 3. And then you get the S&P 500. The S&P 500 is up 1.17. And you look at the 3 stocks. 2 of them are down. The rest, it's pretty mixed. So we're picking the top dogs or top money-losing, high variance, low beta stocks. And we're trying not to pick stocks that are so in play, like AMC or Carvana. Truthfully, Carvana is falling into potentially bankruptcy or insolvency, so what are you going to do there? But I don't know that I want to, that's not a model pick. That's more of a personal pick. Now we look at the S&P. This is where it got interesting for me. So if I do an hourly on the S&P, you see it's been on a nice steady incline. The stochastics running about in order. This is on an hourly chart. The MACD is up. The MACD is up right now. Relative volume's up. Money flow is up. So people are putting money to work in the S&P 500 right now. Right now. 38.58. It's up 1.1% and it's up for sure. Look at the banks. You guys know we like to look at the banks. It's one of our specialties. We're not actually making money on our bank investments, but that's okay. We're in. We're in it to win it. And so TLT is up. So bonds, long bonds are up. Long bonds are up. They're up 1/4 point. Mid-range notes up a tiny bit. So what this is showing me is it's not a big move. It's not a big move on the bonds. But then you look at all these expensive banks. These are banks with a high valuation when compared to the equity of the company. They're almost all up. You got to get down to like Esquire, which is like one branch in New York, right? You know, GABC, German American Bank Corp out of Indiana is down, but that's a little bit of a tough one there. So not a lot of movement. I mean, they're all up or down, like, you know, within 1%, roughly speaking. Low volume, though. Banks are not really moving. 11,000 shares, 20,000, 100,000, 200,000. It's not a lot. 15, 9. Not a lot of movement. Now, CMA has a lot of movement because CMA is Comerica. It's a big bank. It's up $2, 2.8%. It's probably going to hit the average volume today, but probably no other stocks are really going to hit the average. Even SIVB, which is a private equity venture cap bank, relationship bank, for companies that are funded by private equity or venture cap, they put their money in SIVB and they use SIVB to help them raise money. That's probably the highest risk bank we know, and that's up 3.5%, 3.65%, 3.7%. So the banks are up a little. Tough to say where we're headed, right? So crypto. Physical miners doing great. Look at that. Physical miners are just across the board happy. Bitcoin and other cryptocurrency miners down. What happened was FTX broke. Their tokens broke, their money broke, they're being bought by Binance. They stopped doing business. I'm sure they were hacked or something, or they broke. They broke. And then Riot actually issued revenue and earnings, which were worse than expected. So HUT is down to like $2. I mean, come on. I remember when it was $10, $12. It's tough. This whole Bitcoin thing is tough. Tough to play in that space. Okay, computers, chips, telco. I look at this as enterprise IT. It's not all enterprise IT, but it's close enough. It's up, except for DXC, which is an outsourcer. Oracle's down a little. Nintendo is down a little. But for the most part, enterprise IT is doing okay. Look at the overall. I love FinViz. And the reason I'm showing you FinViz, and I'm going to show you some other charts. Hopefully you like this low energy, kind of quiet video today. I'm not noticing anybody even watching. Maybe I'm too quiet. Too quiet? Maybe. I don't think I'm too quiet. Normally I'm pretty darn loud. So 3.5, 4.8, 4.1, 4.25, 4.14. Okay. So the first thing I wanted to look at was, where are we with stock? So new highs, new lows are about balanced, which is nice. Advancers, decliners. Advancers are up over decliners. But if you take a look, the stocks that are going up, pretty big percentages. The stocks that are going down, pretty big percentages. The whole market looks like it's going up, but Lyft is down 20%. So there's just significant punishment in the market. Party City down 40%. RCM, R1 RCM, which is, we know them from downtown Chicago, it went from $15 to $8. Unis has dropped half. These are big moves, right? Big moves. So we're not expecting always these big moves. This is not normal. If we look at trending tickers based on whatever Yahoo Finance decides to show us, Lyft, Bitcoin's down 6%, which isn't that big of a deal. Coinbase is down 7%. Take-Two Interactive Software, they announced yesterday. FTX token, remember I said that? They were broke or something. They down 50%. R1 RCM, they're a revenue management firm for healthcare providers, down 50%. Book Road Generation is up a third. Gold is up 2%. Ethereum is down 8%. MicroStrategy down 15% because they have a play in Bitcoin. TripAdvisor down 17.5%. Robinhood is down, but DuPont Nemours is up 8%. These are big moves. I get nervous about this market. This market could move up or down, but when it moves, it's really going to move. 5 nines, big moves. So maybe that's the point about this. Maybe the whole thing we should be saying is QQQ is extremely volatile. Big moves in individual stocks. And currency's coming back. Look at that. The euro is over $1. Japanese yen is under 146. It's a big change. Canadian won is 7.25 per dollar. That's right at the edge there. It's pretty weak. They weakened. Hong Kong weakened. 7.85. I don't remember ever seeing it that high in my whole life. 7.7 was where the Hong Kong dollar would trade. Now it's 7.85. It broke. The rupee, 81.3 per dollar. So whatever's happening, we've broken currencies. There's broken currencies, but the euro looks pretty okay, up over $1. Again, most actives. It's a lot of most actives. I didn't realize there were that many most actives. Oh. All right, like Lumen Tech. That's like a data center operator. 5%. Newmont 7. There's just big moves. Big moves. Not expecting it. So the question for us is, can our model hold? Can the model hold? Can we continue to find that edge when the riskiness of the market is so high? What if the market were to go up or down 3 or 4%? Would the risk mitigation of our model of stocks working together, of highly diversified stocks, create the edge over the index moves? And for sure, can they do better than the QQQ if you have 38 stocks versus 22, right? Many, many more stocks for the QQQ. And the QQQ is going to move more. So obviously on a down day, you're going to make a killing. And on an up day, you're going to lose. So for QQQ, my guess is that there's less of a consistent edge. You do well when the market goes down. You do worse when the market goes up if you hedge with QQQ. So that's going to be the question. If you're an investor, if you're considering to be an investor, do you want to hedge QQQ? Less edge, but traditionally QQQ drops way faster than the S&P 500. When the market goes up, S&P 500 goes up less quickly, and your stocks are going to go up. So you're going to do better probably on the S&P 500 in a normal market, but on the QQQ, if you're worried about downside risk, you're going to do better on QQQ. So there you have it. That's where we're at. And we also could just change the hedge as opposed to changing the long run, but that takes us into the world of just guessing and not analysis. So thank you very much for watching. I hope you're doing okay in the markets. Most people I know are losing their shirt. Just do it. I still have my shirt. I love the shirt. I think I bought the shirt when I was 25 years old. Still fits, baby. Oh yeah. I'm 54 years old. Got that right. All right. Thanks for watching. Good luck in the markets. You take care. Oh, and if you haven't voted yet, polls I think are open until 7. So good luck. Bye-bye.